5 minutes, clear signals, real results. That's not just a slogan, it's what UGRU Stocks delivers. My name's Ken, and today I'll show you how everyday investors consistently beat the market and why we've kept it a secret for 3 years. You're here during a special 21-day window where we're opening our private beta program to founding members. I'll show you why most investing fails people for the reasons you see here and how to prevent those experiences with UGRU stocks, which should take about 20 minutes. If what I share makes it obvious that investing can finally be simple, clear, and effective, then I believe your smart choice is to join us to grow your wealth confidently in 5 minutes per month. But first, a bit about me. I've been a financial professional for 30 years. I left Merrill Lynch in 2006 to start a successful fiduciary practice, which I sold 10 years later. I have a long list of career accomplishments, but the one that matters most is being a student of finance. This afforded me the ability to create tools that sidestep crashes like 2008 and a very different crash that is upon us I wrote about in my most recent book. The accomplishments are nice, but right now I'm here to help you, so I'll share something that we haven't made public until today. We've been running a secret beta program for 3 years. We didn't advertise it. We didn't promote it. We kept it completely private while we selected 60 people from different backgrounds, experienced investors, and complete beginners with one requirement: follow our alerts exactly. The results were amazing. Every single member who followed instructions, 100%, consistently beat the market while others struggled with losses. While most investors were guessing about electric vehicles, AI, crypto, and losing money, our system was crushing the markets with clear entry and exit signals. You might ask, why wait 3 years? Simple. I refuse to launch half-baked promises with fake, back-tested claims. We perfected this system, ironed out every wrinkle, and only now that it's proven are we opening it to the public. Now, this is your chance to join the same system our beta members use to beat the market consistently. I know classic thinking questions whether it's too good to be true. Some of our beta subscribers felt the same way. In fact, we found that the smarter the beta user, the more they struggled in the first handful of weeks simply by overthinking. Smart investors tend to fall into the paralysis, drowning in data until they miss the moment. Then they second guess the strategy, listening to noise instead of following the plan. And third, emotions take over like fear and greed, leading to costly mistakes. Those people found that the most important quality for an investor is temperament, not intellect. So please pay close attention to the next 15 minutes. Before I show you exactly how this system works, I want to ask you 3 questions about your current investing approach. If you purchased a house, Tesla, or Bitcoin, would you say you invested in real estate, stocks, and crypto? What you may not know is successful investors only ever invest in one thing: probability. And understanding what this is when it comes to your investments will determine your success. If not, you're simply gambling, keeping your decisions based on an emotional cycle which is recycled over a lifetime, putting you in the category of the average investor making decisions based on 3 things: historical pricing, popularity, and if they buy that product themselves. All of these make for incredibly unsuccessful investing. Take point number 1: investing because the chart looks like it has a history of going up. When people look at charts, what they're seeing is the past, and that's like driving down the road using only your rearview mirror. This is a trailing indicator, which is the same outdated information that you get from the news, rumors, or a YouTube video. What we want are leading indicators. So, most turn to the garden variety financial advisor, charging 1.5% per year in hopes they get leading insight from a pro. But what they get is mediocrity from a portfolio benchmarked on the S&P 500. In fact, almost every advisor uses ETFs that mirror the index, like the SPY, which is a Wall Street and Main Street favorite, with 6.5% returns in a steady market cycle from 2000 to 2020. But no matter the period or return, the average hides brutal realities. 92 years of data shows 1 in 4 years you lose money. More than half the time, returns are below 10%, with single year losses ranging from 20 to 47% on 5 occasions. Even in that steady 2000 to 2020 period, there was a 37% loss and 3 straight losing years totaling 50% when retirees needed it most. The point is, passive investing equals zero protection. Advisors might tell you that it's time in, not timing, that's important. But the reality is that your retirement is, in fact, a market timing gamble, with expenses guaranteed to destroy your retirement. SPY's 9 basis point fee on $150,000 is 10 grand over 20 years. But the problem is seriously compounded with advisor fees. Here's the math. $150,000 growing at 9% over 20 years grows to $840,000. Subtracting 1.5% advisor fees leaves $637,000, totaling $270,000 in fees alone. Still yet, you may believe the advisor can time the market. Some advisors are in fact smart enough to do that, but it's likely to never happen because of something called the KYC profile test, which asks you a simple question like, if the market dropped by 20%, would you A, take your money and run, B, do nothing, or C, invest more? Every other question is substantially similar. Now, the test scores you to neatly fit you inside of a standardized portfolio. So if you scored as a growth and income investor, your portfolio might look like this. Problem is that now there's expectations from all parties to largely stay allocated the same until you take another arbitrary test. So even if the advisor is smart enough to know that we're expecting a 30% drawdown in stocks, they're not agile enough to make those decisions. This is not only important, but it's critical. Why? Because according to research from Charles Schwab, market corrections happen every other year. Let's forget about fees for just a minute and do some simple math. If we invest $100,000 and the market corrects by 10%, we're left with $90,000. But getting a 10% return the next year doesn't make us whole. If we had the tools to mitigate a large part of those losses, we would preserve more money, and even if we underperform the markets on the rebound, we are still $7,000 better off. Play this out 6 times over 20 years, throw in a couple 30 and 50% drawdowns, and the difference from published averages and your account balance is staggering. It's far easier for the professionals to gaslight us, which is why you may have heard excuses like, we outperformed the market that was down 30% because you were only down 27. Or maybe they say it's only a loss if you sell. Think about that statement. The money manager, your advisor outsourced your trust to manage your money, does exactly that. Buy and sell, attempting to outperform the indexes, which brings me full circle to their widespread failure to do just that. They make it new every year, but I've seen this on the news yearly for 25 years, and I'm sure you've heard at some point that 80% of fund managers fail to beat the market. It's not because they're incapable, but because of the profile the SEC wants and your attorney making the promise to reinforce. Put simply, it's because you're in their neat little box. So, what can we do? Well, the first thing is to understand where the fiduciary responsibility starts and stops with investment advisors. And it starts by the way they're paid. They're compensated by the amount of assets under management, which incentivizes them to sell you on their service, put you in a box based on your profile, outsource the heavy lifting so they can move on to sell the next person willing to invest in them. The sad part is that most Americans are seriously held back by this rinse and repeat cycle, and they're looking for answers, but are finding themselves corralled in a few options. You can underperform with an advisor, take all the risk on individual stocks like Tesla, which I'll talk about in a minute, or you can give up by simply throwing your money into one of the indexes, but you're probably not enjoying the performance of private equity, venture capital, or hedge funds. Because 90% of us don't financially qualify. Not qualifying means that you're missing out on life-changing money because private equity has quietly outperformed the S&P 500 over the past 5, 10, 15, and 20-year periods by about 5%. Let me show you what that really means. So back to our $150,000 invested over 20 years at 9.7%, we would have just shy of $1 million. Now, that same $150,000 over 20 years at 15.2% is 2.5 million. Let that sink in for just a second and ask yourself, what good reason is there that the masses don't have access to this? Point is that there is an obvious class war going on that most don't recognize, and behind the scenes efforts have fallen on deaf ears for decades. The good news? The world is trying to offer alternatives so that you can be your own hedge fund. The challenge, though, is that they expect you to be your own analyst. Their systems make you do the work, costing you hours of research, leading to endless doubt, causing emotional mistakes, and most don't even publish their performance, all of which chips away at your confidence. UGRU flips the script. We do the heavy lifting and deliver curated signals, removing hours of stress and uncertainty. All we ask is 5 intentional minutes per month, which is very powerful. And here's why those 5 minutes are so powerful. They create discipline because a steady habit builds self control. They build confidence because each action reinforces trust in yourself and the system. They give you clarity, replacing noise and confusion with simple, focused steps. They anchor your emotions, protecting you from the two biggest threats to growing wealth: fear and greed. 5 minutes builds ownership because you're engaged and in charge. After all, your money is not a spectator sport, nor should it be. They free your mind and your time for what really matters. And most importantly, they create momentum. Small, consistent steps each month that compound into lasting financial and personal growth. UGRU Stocks is one of our powerful services designed as your personal hedge fund without all the headache. But let me share a bit of its background and why it's so important to you. As an investment advisor, I used a top down strategy to build portfolios. I've long told clients that I don't have a crystal ball because perfect prediction is impossible. So I've relied on hard data, which is a great alternative. My funnel started with global macro for direction and timing, crude oil as an 18-month lead, sector rotation for allocation, and technicals for precise entries and exits. But the two levers that mattered most was always global macro and technicals. These are key, so stick with me. Demographics drive demand, and big companies spend billions positioning themselves to get you to do one thing: part with your money. Years of this data tells us that earning and spending peaks in your 40s, which is important because more spending increases velocity of money lifting markets. In other words, know a society's peak spending window, and you can anticipate broad market moves. For example, the baby boomers. Everything they've touched has turned to gold, whether it's Gerber Foods from the time they were born to healthcare companies as they've aged. Why? Because there were 76 million of them born between the years of 1946 and 1964, more than any generation before or since. Now, if we adjust for the added immigration and move the chart forward representing the peak earning and spending years of this generation, you can see how it aligns with the Dow Jones adjusted for inflation. The takeaway: population trends are an important leading indicator because it changes who buys and who builds years before revenues show up. You might be stuck on the S&P 500 ETF thinking, yeah, 6.5% over 20 years, but I got in at the bottom of '02 averaging 9% and that's good with me. If so, again, you'd be looking in the past, and looking in the rearview mirror cannot be emphasized enough. So let's look backwards for a minute to see that we've enjoyed a depreciating cycle for 40 years. In 1981, mortgage rates peaked over 18%, and the masses that bought homes in that period at $80,000, for example, sold a handful of years later for $115,000. After expenses, they pocketed, let's say, $40,000, used $15,000 on a down payment for a larger $150,000 home at a far lower 8%, making their new payment similar to their previous mortgage. So they kept the same budget, but now had $25,000 to buy cars, furniture, and stocks. This repeat cycle over 40 years created the velocity effect that I shared earlier and made for easy markets, where you could blindly throw your money in an S&P 500 ETF, forget about it, and be happy years later. Today, we're experiencing a tectonic shift in the economy, and investing will not be as easy as it used to be, because now we have to worry about two different kinds of market crashes. Most of us understand a market crash as losing 20% or more, but we have the same risk of crashing up these days, which means that we're nominally getting great returns like 9%, but real inflation is 9.5%. So our nominal return is 9, but our real return is actually a loss of 0.5%. And that's what's critical about timing right now. We're entering the most volatile period in market history. The old 40-year cycle of declining interest rates is over. The easy money era is ending. This means the next 10 years will separate the prepared from the unprepared. Those with systems will thrive. Those without will struggle. We're stepping into a new era. And I want to put this into perspective for you. This is Fifth Avenue, New York City in the year 1900. Where is the combustion automobile? You can see it here surrounded by horse-drawn carriages and buggies. We had stepped into a new era in 1900, and it only took 13 short years for the same place, Fifth Avenue, New York City, to ask the complete opposite question. Where's the horse? History repeats itself, or rhymes, as Mark Twain says. Every 10 years or so, we have a new era that kicks off. At their IPOs, each of these companies kicked off new eras from personal computing to mass adoption of crypto. We want new era stocks so we have the wind at our backs, but we need to know the best entry and exit points because population trends give rough direction, but could be off by 5 years or manipulated. Think of our system like a GPS for the stock market. Demographics show us the general direction, like knowing that you want to drive from New York to Los Angeles, but you need turn by turn directions for the best route and perfect timing. That's where our technical indicators come in. When there's consensus, they're like your GPS telling you exactly when to turn, speed up, and slow down. What used to take me hundreds of hours each year is now bottled up in our system, taking mere seconds. And UGRU Stocks unbottles all this published performance for you to enjoy, requiring only 5 minutes of your time per month. Not only have we crushed the markets, but following the alerts has beat even a buy-hold strategy on individual stocks like Tesla. Had you bought and held Tesla August of 2022 to September of 2024, you'd have been down over 7%. Our alerts during the same time period logged 170% in gains. Let that sink in for a moment. While Tesla buy and hold investors lost 7%, our alerts logged 177% difference. I wonder how many Tesla holders sitting flat saw the S&P 500 up 35% and regrettably sold their shares for an ETF. Look, I know making decisions with your life savings can be nerve-wracking, but you need to know that UGRU Stocks doesn't have to be where you place all your money, and it shouldn't be. But think about this. If you fired your advisor managing $100,000 and placed 90% in an ETF and used 10% to follow Tesla alerts during that same time frame, not only would you have saved $146 a month in fees, but you'd have had $23,000 more in gains. Or if you're retired and worried about inflation, 90% in a bond would have given you $9,000 to spend and your balance would still have grown to $124,000. The beauty is, you don't need $100,000. A simple $10,000 using not just Tesla, but any trio of our hand-picked new era stocks could prove to add significant value in short order. And you can do this all in the comfort of your current brokerage account. Before I show you exactly what you get with UGRU Stocks, I want to share some of our beta members' experiences over these 3 years. Remember, these aren't theoretical results or back-tested data. These are real people with real money getting real results. Cynthia from Texas said that she consistently outperforms the market while her friends have lost money. Joel from California said it's simple and that it's great to be part of a winning team. And Sean from Oklahoma says he feels more in control and has peace of mind. These aren't cherry-picked success stories. They're real people sharing real success. But you might still wonder, what if it stops working? Fair question. That's why we've tested this for over 3 years with real people happy to share their stories. But more than that, the system is based on the same winning recipe that I used for decades with my wealthy clients through different market conditions. The system adapts because it's based on fundamental economic drivers that don't change. Maybe you're thinking, I'm not good with technology. You don't need to be. Our alerts come as simple text messages. Buy XYZ at $50, sell XYZ at 75. That's it. If you can respond to a text, you can follow our system. When you consider all of the options out there, most services fall into the same traps. They either bury you in data, require constant monitoring, or they give you picks with no clear exit strategy. And here's the kicker, most don't even publish their performance. For those, you'll spend anywhere from a few $100s to nearly $3,000 a year. Plus, the time and stress and second guessing that comes with doing most of the work yourself. So, what exactly do you get when you join UGRU Stocks? Well, if your time is worth just $50 an hour, the automated trade alerts prevent 10 to 20 hours of research every month, saving about $9,000 a year. Alerts are powerful, but they only work if you feel confident using them. That's why we give you step-by-step training and live regular webinars so that you know exactly how to build the temperament of successful investors. This kind of coaching is easily valued at $1,000 a year, but here it's included. And we remove all the risk with our 90-day guarantee right out of the gate. On top of that, we've built in accountability with progress reporting, subscriber support, and the ability to upload your brokerage trade history report for an automated audit of your trades to dial in trading behavior. And there's one more thing that I want to include exclusively for founding members. As a published author, I'm gifting my most recent book on financial psychology and planning, which normally retails for $20. When you join UGRU Stocks today, you'll receive the complete ebook instantly as my personal welcome gift. This is no ghostwritten book. It's 200 pages that build the mental foundation that complements your alerts by building the disciplined mindset needed for long-term success. You'll get instant access the moment that you subscribe. That's a value of over $10,000 per year before locking in any performance. And the cost? $29 while Founders pricing lasts. That's less than what most people spend on a coffee each month. For the fraction of a daily latte, you get a system that could transform your financial future. The choice is simple. Stick with your current experience or join a proven system. The only question left is which subscription is right for you. Now, before you make your decision, there's something critical about timing that you need to understand. What I've shared with you today, this founding member pricing, is only available for the next 21 days or when we reach 1,000 total members, whichever comes first. Then, these prices, they disappear forever. No extensions, no exceptions. When the deadline hits, we return to full public pricing. So, as you look at these subscription options, remember, this isn't just about choosing a plan. It's about locking in founding member rates that will never be available again. So with that in mind, let me show you just how simple the choice really is. When you click on that link, you'll see a yellow button to lock in founder pricing, which will take you to 3 subscription options. Here's how to choose. If you're just starting out, basic at $29 is perfect. If you want extra support, Plus, at $89 includes one-on-one help and can be changed back to $29 anytime. If you want to lock in forever, lifetime pricing is $799, which would be your best value. Here's what you need to do right now. Click the link to lock in your founding member pricing. Once you join, you'll receive a welcome email with everything that you need, including an invite to our private Telegram group and links to your training videos. Go through that training right away. It's short, clear, and it'll show you exactly how to follow the alerts. Once you join, send me a quick message in our private Telegram group introducing yourself. I personally welcome every founding member. Your first trade alert could come at any time, sometimes within 24 to 72 hours. That's why it's important to be ready from the start. Founding member pricing is only available for a limited time. Once it's gone, it's gone. Don't miss this chance to simplify your investing and lock in your spot today.